Talking picture.
Yes, yeah.
Okay.
All right. So I once again I greet you and I welcome you to our
Thank
fifth
you so much.
lecture session, right? In the
Thank
revision
you.
for your KAFV 502 module, right? So
Yes.
I've been scrutinizing throughout the various question papers which you have sent to me. And so what
Yes.
I've decided is an approach to this module, ideally because your exam it will be in the next few weeks from now. So
Yes.
doing a question paper all at once, I feel like I'll be bombarding you with so much information. But what we can do is approach each question individually from different question papers. Like, or rather, let me say, approach a concept as it is tested in the question paper from different past papers, so you can see the typical approaches that they use, and then by virtue of that application you will not be shocked or surprised. Suppose
Okay.
a question, say for instance, they are testing about cash budget, which is what is happening in this first question. You will not be
Mm.
shocked, because you already know
Yes.
what is expected of you. So if we can do maybe, say for instance, three or so of cash budget questions, for example, that way I know you'll
Mm.
be more comfortable, to answer a question of that nature, suppose it comes in the exam. And then in the other lecture session that we would have, then we might deal with something to do with ratio calculations and maybe,
Mm.
combine it with other questions. But ideally, I'm thinking that that could be the best typical approach, so that we can be able to cover many questions, other than just focus
Yes.
on one question paper. So that is my thinking
Oh,
around it. So without any further ado, my sister, let's have a look into the 2023 question paper. There's another document I want to open, and let me convert this to a PDF. I think it would be the best, so that I can be able to make footnotes for you.
okay.
Yeah, let's do that. Let me share the PDF. All right, so I've converted the document into PDF. That way, I think it will be easier for me to make some footnotes and all that, highlight the information and so on and so on. And then what I'll do, I'm gonna draft up a format on the Word document. So what will be happening
Mm-hmm.
is I'll be navigating between the PDF document with the question, and then also to the Word document where I'll be showing you how to answer the question accordingly. Right.
Okay.
Wonderful. So, anyways, without any further ado, my sister, let's have a look into question one of the 2023 um, academic year. So, here you have it. So, the first typical approach that you should always apply when you're answering any question, be it even in any other module, start by assessing or evaluating the required section of the question before you go through the system. I mean, before you go through the case study that they've given you. So in this context, we are required to draft a detailed cash budget for the month of January 2024, as well as February 2024. So this question in particular, it's equivalent to 30 marks in terms of mark allocation, as you can see there. Right. So
Yes.
now we're going to So now, once you have done that, then the next step you do would be obviously to draft up a format for yourself. Say you're already in the exam and you're trying to answer a question of this nature before you can even go about, evaluating the information. So I'm going to try and open up a format that I had already drafted to this effect. So let me just quickly open the Word document for that, and then I'll be navigating to it. Okay, let's close this. So I'm just gonna call in. By the way, I would share the document with you after we are done.
Okay.
Yes.
Appreciate it.
Not a problem. So this is question one. It's A. It's KAFV502 2023 question paper. All right, great. So let me just draft this here. All right. So we want to draft the format of the answer book. My question would be, with these past exam papers, do they normally provide you guys with answer book in the exam, or you have to draft the answer formats for yourselves? I just wanted to kindly confirm that.
I'm not sure because it's my first time.
Or it's your first time?
So yeah, so I don't know. So I think they're gonna give us an answer sheet.
Oh, okay. Why
Yeah.
I'm asking is because I wanted to know whether you are supposed to draft the formats by yourselves without, being provided any, or perhaps maybe they would provide you guys with one. So that's just one of the things I wanted to make sure that it's clarified. But nonetheless, um, this is how you're supposed to draft a cash budget format. So normally, you follow the number of months that they want you to account for. So the first column, ideally, it would be a column whereby you are writing the details of the line items, okay? And then in
Okay.
the second column, this is where you indicate the first month, which is the month of January. And then, of course, on the other month column that you'll be indicating the month of February, as it were, right? So then, okay, let me just open this document quickly to make it easier and quicker as well. Um, okay. Oh, where is it? Right, there we go. There's just something I want to kindly open here,
Okay.
just for the sake of the format. So I just want to copy this and then I'll paste it in that document to make it quicker. Yeah, I think that way to make life easier for us. Just also for the interest of time, I'm thinking it would be the
Yeah.
best. Yeah. Anyways, so just ignore the amounts and everything. So I just want to format all of this. Right. So the first month, of course, in our case, it is the month of January. And then the second month is the month of February 2024. Right, like that. And then, like I indicated earlier, this column, the first column, this is where you'll be dealing with the line items typically, right? So I'm just gonna erase some of these details over here. In fact, I'll adjust most of it as we move along. But what I want you to understand about the cash budget, it has two sections. Um, the first sections really being the cash receipt section. All right. So it ideally deals with all the monies which the organization received or anticipate to receive. All right. So anticipate to receive,
Okay.
given that it's going to happen in the future, right? Right. And
Yeah.
then it will have another second section to it, which deals with cash disbursements, or rather cash payments, which would either have occurred already or they are anticipating to occur at a later date in future. Hence, it's called a budget. So a budget, you're giving a prospective future of how your cash flow is going to take place within the organization. So I'm talking about how the organization is going to receive money and how they're going to spend that money. And at the end of the day, we need to be able to determine what is left
Mm.
when they've received and also, of course, when they've spent. So that's what we call net cash flow. So net cash flow basically is just the difference between the total cash received less the total cash spent or cash disbursed, right? And then in the context of the question, they might tell us, if ever there's an opening balance from the previous month. When I mean previous month, I'm referring to the month of December 2023 as it is now.
Mm.
Because, of course, in this case, this month, January and Feb, they are for the 2024 financial year, right? So an opening balance in the month of January 2024 would be a closing balance for the previous month of December 2023. So that's what is denoted here as the beginning cash. So it will come over there if they've given us one in the question. And then, of course, supposing, let's say, if it was a positive amount of 40,000, um, and then we had obtained the net cash maybe to be a negative value of 10,000. So if it's a negative value, normally you put it in brackets, right? So then the ending cash is just basically the difference between your net cash and the beginning cash amount, right? So in this case, the negative versus positive, that's going to give you a difference of a positive of 30,000. If there's a
Mm.
minimum cash balance which the company is supposed to maintain monthly, we will indicate that amount over here. So if it was 50,000, then you indicate 50,000 over there. If they had any form of short borrowings, meaning to say maybe it's a short-term loan which they had obtained. So under normal circumstances with short-term borrowings, it will be a bracketed amount over there. So I'm just using typical actual figures to make it easier. So in this case, you're gonna take the 30,000, add the 50,000 and less the 20,000 to be able to give you the excess cash balance there at the end of the month of January. So the same thing would also need to be done for the same month of February. But I want you to observe now that the closing balance or the ending cash in the month of January of 30,000 would be used as the opening balance in the month of February. So that's how it works as far as this aspect at the bottom is concerned, right? So this was just for illustration purposes. So now we want to answer the question that we have been given, and I would make some adjustments accordingly as we proceed with our question. So to do that, let's go back now to the question paper and we do the evaluation of the line items that we have been provided with. So now, observe what you are given here. The following information is presented to you. So what do we have? In line item 1, we are given the selling price of product per unit, which is 5 rands 50. Now, the moment you're given a price per unit, you need then to determine the quantities that have been sold or that is anticipated to be sold over those given months that they want you to reflect the cash budget for. So in this case, this for now, we'll just put the information aside, but then we need to determine what are the units that the company is anticipating to sell over those coming months. So anyways, sales collections takes place as follows. So 40% is cash sales. So now, and then 25%, in fact, let me do it this way. So I'm just going to highlight this. So they're saying 45% is cash sales. So that tells me that the rest would be credit sales, meaning to say the 55% is credit sales. So credit sales would be collected over a certain duration period of time. So we want to determine or anticipate how they're going to be doing the collections of debt from their customers. So in this case, you need to break it down for yourself. So 45%, that's cash sales. This therefore implies that 55% of the total sales in this case it's credit sales. Are we together, my sister?
Yes.
Wonderful. So we have that to note. Then now we are told 25% is collected in the month following the sale. So that they are basically now breaking down the collection of these credit sales. So
Mm,
25% is collected when? Month following the actual month of sale. So meaning to say, if we sold products in the month of January, the 25% of the 55% is collected in the month of February. That's what this means
mhm,
when they say 25% in the month following the sale, and then 25% in the second month following the sale. Meaning to say, the other portion of the 25% is collected when in the month of March, right? But still dealing with the month of January in this case. So now, basically, they are saying to us that only 50% of credit sales will be collected. Why? Because the remaining balance, which is in this case going to be 50%, is going to be accounted for as bad debt. That's what it means when they're
mm.
saying balance is irrecoverable. Are we together there?
Yes.
Wonderful. So now, that was just to give us perspective of how they're going to be collecting um, you know, sales, the credit sales from their customers, as well, of course, giving us in the breakdown of how the actual cash sales are determined in this case. Now, notice that with information one and information two, we are not given yet the number of units which this company is anticipating to sell for the month of Jan and is even also for the month of February. So we are still looking for that information. So we continue. Labor is paid in the month incurred and makes up 40% of the cost of the product. All right. So now this, of course, it entails with cash to do with cash disbursements. So now, but notice the labor is predetermined on the cost of the product. Now, the first information and the second information we've been given, it's only dealing with sales. We are not yet told what is the cost of sales determinant factor in this case. So we need to still find out about that. They would most likely, of course, give us that info. Now, information number four, the total cost of the product is 4 rand per unit, of which raw materials make up what? 30%, which is fine.
Mm,
Um, Now, the most important thing that we are mostly interested in this case is the price of the cost of the product. Why? Because that way we'll be able
okay.
to use it to determine, even the cost of labor that we're given here. Because the cost of labor is dependent on the cost price of the product. So we have given now the cost price of the product, but per unit. Now, information
Okay.
number five: production overheads, including depreciation, make up the balance of the cost of the product, right? And then 50% of all overheads are paid before the end of the month in which they were incurred, and the balance 1 month later. Notice 50%, that's half. So I want
Mm,
us to break this information down so that by the time when we actually begin to answer the question, we'll be able to use it accordingly. So production overheads, including depreciation. So that already tells me something. There's depreciation already included in the production overheads, meaning to say, we first of all then need to take out the depreciation to be able to
okay.
get an accurate amount. I don't know if it's making sense to you. Is it
What
making
is depreciation?
depreciation? It's basically how do I put this? So whenever it's the loss of value in an asset
Okay.
by virtue or by reason of using the asset over a certain period of
Okay.
time. So let's say we have an
Mm,
equipment that we are using in our office, and it's anticipated that the equipment will be used for
mm,
the next 5 years. So depreciation will be used to account for the use of that asset over the period of its useful life. Meaning to say, if we had bought the equipment today for 100,000 rands, by the time we've used the asset for 2 years, the value of that asset can no longer be 100,000 rands. Why? Because it has been used or it has depreciated for those 2 years.
Oh, okay.
Yeah, that's basically what depreciation is. So depreciation,
Okay.
as far as cash budget is concerned, it's a non-cash expense. So you need to indicate that in your cash budget, right? So
Okay.
when you say production overheads less depreciation, you need to indicate why you're saying you're subtracting the depreciation. It's simply because depreciation is a non-cash expense.
Okay.
Yeah. So it
The
is.
loss of value itself.
Repeat again.
Is it the loss of value?
Yes. Yes. So it's the loss of value in asset by reason of using it. So for as long
Okay.
as the asset is in use by the company, it will begin to depreciate in value or it will begin to
Mm.
lose value because you're using it. You know, that's
Okay.
yeah. So that's why, like, I mean, I can give you a good example with a common thing that you know. So let's say you bought a vehicle 5 years ago. I know, let's just
Yes.
say 3 years ago. Maybe you bought it for 300,000 rands, right? If you
Yeah.
had to value that car today, or if you go to a car dealership and they want to revalue the car today, they would consider the number of miles that you have traveled with that car.
Yes.
And you
Yes.
discover that if they are to do their calculations where they depreciate the vehicle's value, you will no longer be able to sell maybe the vehicle for 300,000. It will probably be sold maybe for
Yes.
50,000. Why?
Yes.
Because of depreciation, you see.
Okay.
Yeah.
I get it now.
All right. All right. Perfect. Perfect. So, and then another thing that we are told here, which I want us to make sure that we articulate, they're saying production overheads, including depreciation, make up the balance of the cost, make up the balance of the cost of the product, right? That tells us something here. They're saying the total cost of the product is 4 rand per unit, of which raw materials make up what? Make up
30%.
30%. So when you're looking at the cost of a product, it involves two things. There's raw materials, there's purchases, you know. In fact, there are three things. So when you are producing a product, it goes through the raw material stage, where it's just basically materials that have not yet been assembled. Then the moment you begin with the production process, it will undergo another stage, which we call work in progress. All right. So when it's in work in progress, the product is already being produced, but it's not yet at a finished stage as yet. So when it's now ready for use by the end user, we call that finished goods, right?
Mhm.
So now the finished goods state, that's when it's now possible to sell it to the user. So now when they're telling us that 30% out of this product cost is raw materials, then the remaining 70%, it is probably finished goods or also inclusive of work in progress in this case. So now I'm saying this because of what they are telling us in information number 5, where they're saying production overheads, that is of course including depreciation, make up the balance of the cost of the product. So what do they mean when they're saying it makes up the balance of the cost of the product? It's very simple. Um, if you look at the cost of the product, there's 30% raw material. So first of all, we have to then determine that 70% out of that cost. That's what is making up the production overhead they are talking
Mm.
about. So now,
Oh, okay.
meaning to say, let's assume maybe they sold 15,000 units, right? So if they'd
Mm.
sold so I'm just doing this so that you can get a picture. So if they had sold
Mm.
50 units, that means 15 units multiplied by 4 rand. All right. And then of course we have to multiply this by 70% because that is the balance that they are talking about. And then that way we
Mm.
get a certain value, which I want us to calculate. Just let me quickly get a calculator. So 15,000 rands times, so 15,000 units multiplied by 4 rands and multiplied by 70%. That would give you something like 42,000 rand. Okay. Now,
Okay.
meaning to say, out of that 42,000 rands, that 42,000 rands is what is equivalent to our production overheads
Mm,
together.
okay.
That's what is equivalent to our production overheads. So when they're saying it make up the balance of the cost of the product, remember we are told the total cost of the product to be 4 rand per unit, of
Fine.
which raw materials make up 30%. So the other difference,
Mm,
that's what makes up the cost of production overheads they're talking
product
about. Yeah.
overhead.
Yeah.
Okay.
Now, but then depreciation is still needs to be determined. So we are told
Yes.
50% of all the overheads are paid before the end of the month. So let's assume maybe out of the 42,000 rents, we already took out depreciation from it. So if you had to determine now production overheads for the current month, they're saying 50% of all overheads are paid before the end of the month in which they were incurred. So meaning to say the production overheads for the month of January, 50% of it is paid in January, and then the other remaining balance will be paid in the month of February. Does it make
Okay.
sense?
Yes.
Right. So meaning let's assume now maybe in the month of February their total production overheads was 50,000. So you're going to have two things. You're going to have 50,000 for the month of February.
January.
Mhm. Multiplied by 50%, right? And you're gonna add now for the other 50% portion of the month of January, which they are saying here, and the balance 1 month later. So the balance of the production overheads for January are paid
Mm,
in the month of February. So in this case, it will mean I'll take then 42,000 multiplied by 50%. This will be the production overhead costs to be accounted for in the month of February.
mm,
Does it make sense?
mm. Yeah, it does.
Did you lose me there?
Mhm.
All right. Let me repeat it so that you follow. So let's assume,
Yeah.
right? Let me make it easier for you. So let's say you're trying to determine the production overheads for January, right?
Yes.
For the month of January. So let me take you to the whiteboard screen. It would be easier like that.
Okay.
Yeah. Let me do that. Excuse me. All right. Can you see the whiteboard?
Yes.
All right. So what I'm saying is, um, so you have the month of January over there, and then you have the month of February accounted for over there. And then this is production overheads, right?
Yes.
So you want to know, okay, so what is the production overheads to be accounted for the month of January, and what is the production overheads to be accounted for in the month of February? So that's what I'm trying to illustrate, right? So here's how it's gonna
Mm,
work. Here's how you're gonna show the calculation. So, assuming that already so you're gonna have then over there somewhere there January, and you had already done your calculations to get to that 42,000, right? Whereby we had said
yes.
15,000 units multiplied by 4 rands, multiplied by, we said 70%,
Event.
right? Which is that balance for the production overhead costs. In fact, then they said only 50% and get will be paid in the month when the production overhead cost was incurred. So we're going to then multiply by
15.
50%. Are we together? So if I
Yes.
say 15,000 times 4 rands times 70%. That's where we got
Mm.
that 42,000. But then only
Yes.
50% of it is paid in the month when it was incurred. So then times 50%, that would give me 21,000.
So we're gonna take that 42,000 and multiply it by 50%.
Repeat again. We cannot take what?
We're gonna take the 42,000 and
Yes,
multiply
and
it by
multiply it by
50%.
50. Yes, exactly. So here, what I
Okay.
just simply did, I just showed you the calculations straight away.
Yes.
Yeah, without having to show the
Okay.
42,000 calculation first, then and then about multiplying with
Okay.
50%. Yeah. So I just combined it as one
Okay.
thing. So that's
All
where we
right. I get it.
oh now it's making sense, ne?
Yes.
Right.
Yes.
So now that's where the 21,000 is coming from. And then now we want to
Okay.
deal with the calculation for the month of February, right? So we already know
Yes.
that for February, there is a 50% portion of January which will be paid when? In Feb. So I'm just going to take that
Yes.
21,000 because that's the other 50%. Does it make sense?
Okay. Yes.
Uh-huh. And then we're going to add, let's say with the calculation for February. So let's assume the total of production overheads for February was 50,000 rands. But remember, out of that 50,000 rands, only 50%
Mm.
will be paid in the month of Feb. And then the other balance is going to be paid when? In the month of
Much.
March. But we are not dealing with March in this case. So
Yes.
I'll only deal with anything that affects the month of January and February. So now if I say 50,000 times 50%, that's going to give me 25,000 rands. Then
Yes.
25,000 rands plus this 21,000.
Okay.
It will give me 46,000 rands, which is now the total production overhead cost for when? For the month of February. So it's going to be 46,000 rands. Does it make sense?
Okay. Yes.
Yeah. So that's what I was trying to explain earlier on from that other screen. But anyways, I'm happy you're following. You can get it. So now let's go back to our question. Let us go back to our question. So yeah, this I'm just gonna delete for now because I already explained it to the on the whiteboard screen. So now let's continue to information 6. So the following sales estimates have been prepared for us. So notice we are given units from the month of November. We're also given units from the month of December 2023 all the way up to the month of February. So all of these are units sold
Yes.
and the units anticipated to be sold because maybe the month of Jan and Feb, they've not yet ended according to the question in this case, but already November and December, these are probably past months already. So now,
Mm.
and then so this information, we'll use it when we are dealing with the sales per unit, and we'll also use
Okay.
it when we are dealing with the cost of the product per unit. So that's where those units will be
Okay.
used, or that's where they'll be applied. Are we together?
Yes.
All right. And then on information number 7, we are told that depreciation on manufacturing equipment, they amounted to, for the month of December, we are given 2.5. For the month of January, we are given 3.5. And then for the month of February, we're given 3.5. So these depreciations, especially for Jan and Feb, they should be subtracted from those production overheads that we calculated earlier. Meaning to say for the month of Jan, I it was 21,000. So we then take that
Yes.
21,000 and you subtract 3.5. Meaning to say the
Okay.
balance for production overheads is supposed to be 17,500 for the month of Jan. And then for the month of February, we calculated to be 46,000. So 46,000
Mm.
less that 3.5, you would get something like 42,500. That's how the production overhead
Mm.
costs would be affected by the depreciation. So I'm just showing that as an illustration. So my sister, what you do now,
Okay.
let's connect for part B shortly in the next minute on the very same links I've shared.